Hello. So today I'll be talking about the Black Monday, a day to remember, and a day that the stock market really went down. So, what exactly happened that day, and why is it called a Black Monday? Well, Monday, October 19th, 1997, is known as Black Monday. On that day, stockbrokers in New York, London, Hong Kong, Berlin, Tokyo, and just about any other city with an exchange, stared at the figures running across their, displays with a growing sense of dread. A financial strut had buckled, and the strain brought world markets, tumbling down. So here's some key takeaways, right? The Black Monday stock market crash of October 19th, 1997 saw US markets fall more than 20% in a single day. So you already understand what, the implication of, stock market falling 20% in a single day is really tragic. And it is thought that the cause of the crash was precipitated by computer program driven trading models that followed a portfolio insurance strategy as well as investor panic. So people were really, panicking at that particular moment. And precursors of the crash also lay in a series of monetary and foreign trade agreements that, depreciated the US dollar in order to adjust trade deficits and then attempted to stabilize the dollar as its new lower value. So let's just take a look at some of the key points and what really happened that day. On that day in the United States, sell orders piled upon sell orders as the S&P 500 and Dow Jones Industrial Index both shared value of in excess of 20%. There had been talk in the US entering a bear cycle. The bulls had been running since 1982, but the markets gave very little warning to the then new Federal Reserve Chairman Alan Greenspan. Greenspan hurried to slash interest rates and called upon banks to flood the system with liquidity. He had expected a drop in the value of the dollar due to an international tiff with the other G7 nations over the dollar value. But the seemingly worldwide financial meltdown came as an unpleasant surprise that Monday, right? So what really happened? Exchanges also were busy trying to lock out program trading orders. The idea of using computer systems to engage in large-scale trading strategies was still relatively, new to Wall Street, and the consequences of a system capable of, placing thousands of orders during a crash had never been tested. One automated trading strategy that appears to have been at the center of exacerbating the Black Friday crash was portfolio insurance. The strategy is intended to, hedge a portfolio of stocks against, market risk by selling short stock index, futures. So now let's just take a look at how it really happened and what really went down, right? So what caused the stock market to crash in 1987? So according to Facts on File, an authoritative source of current events information for professional research in education and education in 1987, crash marked the end of a 5-year bull market that had seen the Dow Jones rise from 6 points in August 1982 to a high of 2,722.42 points in August 1987, unlike, happened in 1929. So now let's look at some of the causes, right? The first cause here states that um, derivative securities was one of the reasons. Initial blame for the 1987 crash centered on the interplay between stock markets and index options and future markets. And in the former, people buy actual shares of stock. In the latter, they are only purchasing rights to, buy or sell stocks at particular prices. Thus, options and futures are known as derivatives because their value derives from changes, in stock prices, even though no actual, shares are owned. The Bradley Commission, also known as the Presidential Task Force on Market Mechanisms, which was appointed to investigate the cause of the crash, concluded that failure of stock markets and derivatives market to operate in sync was the major factor behind the crash. So we've seen the first cause, and the second one was actually computer trading. In searching for the cause of the crash, many analysts blame the use of computer trading, also known as program trading, by large institutional investing companies. In program trading, computers were programmed to automatically, order large stock trades. So yeah, this is one of the main reasons. So once you know other large stock trades when certain markets trend prevailed. However, studies show that during the 1987 US crash, other stock markets which did not use program trading also crashed, some with losses even more severe than the US markets. So now let's take a look at the third one, illiquidity. During the crash, trading mechanisms in financial markets were not able to deal with such a large flow of sell orders. Many common stocks in the New York Exchange were not traded until late in the morning of October 19th because the specialists could not find enough buyers to purchase the amount of stocks that sellers wanted to get rid of. So we can get to see where one of the problems, where then many common stocks in the New York Stock Exchange were not traded until late in the morning of October 19 because specialists could not find enough buyers to purchase the amount of stocks that sellers wanted to get rid of at certain prices. So the prices began, were stalling, and because people were not, getting to buy it at the price people really wanted to sell their stocks. So as a result, trading was terminated in many listed stocks. The insufficient liquidity may have had significant effect on the size of the price drop. Of course, when you don't get to sell your particular stock at the price you want it, it keeps stalling, and it could really cause problem. And however, negative news to investors about the liquidity of stock options and futures markets cannot explain why so many people decided to sell stock at the same time. We also know that when people get to keep stock for for long and get to sell it at the same time, it could make the market, you know, be a certain way. And um, let's take a look at one of the causes as well, the fourth, the US trade and budget deficits. Another important trigger in the market crash was the announcement of a large US trade deficit in October 14th, which led Treasury Secretary James Baker to suggest the need for a fall in the dollar on foreign exchange markets. So, fears of a lower dollar led foreigners to pull out of the dollar dominated assets, causing a sharp rise in interest rates. So, once you decide to devalue the dollar, and you know that in this case, foreigners, you begin to pull out of, trades and investments. So, in this case, it was one of the reasons why the crash did take place. And the fifth is actually investing in bonds as as an attractive alternative. So long-term bond yields that had started 1987 at 7.6% climbed to approximately 10% the summer before the crash. So this offered a lucrative alternative to stocks for investors looking for yield. So now, the sixth was actually overvaluation, right? So many analysts actually agree that stock prices were overvalued in September 1987. Price, earning portfolio, earning ratio and price dividend ratios were too high. So this was also one of the reasons, and does not imply that overvaluation caused the 1987 crash. While these ratios were at historically high levels, similar prices, earnings, and price dividends value had been seen for most of the 1960 to 1972 period. And the legacy of the crash was that what of 1987 crash ultimately accomplished was to teach politicians that markets heed their words and actually carefully, reacting immediately when threatened. Thus, the crash initiated a new era of market discipline and bad economic policy. So, these are the key points. These are the main reasons why the market really did crash then, and you know things are actually better now. People have learned a lot, and you know the market is going better now.